Well, welcome everyone. We're excited for this discussion of Fundiscovered America, finding low risk, high returns in U.S. markets. We're also kind of happy to be back in Europe, even though we're only virtual here, for Paris Real Estate Week. And for some, we were planning to be together, I believe it's for MIPIM in March. So we're a little delayed due to this little thing called COVID, but we're back together for this panel and looking forward to a really great conversation. My name is Chad Gleason. I'm the Managing Director of Pentaveret Global Investments, which is a global capital, port of entry for global capital for institutional real estate here in the US. I'm also a board member of the National Association of Realtors and CCIM Institute. If we'd like to go around the table here, maybe starting with Barry, with an introduction of who you are and how you're associated here.
Sure, thanks very much, Chad. So my name is Barry Cosgrave. I'm a partner at Mayer Brown International. I'm based in London. I live in London, but a lot of time in our Middle East offices. A lot of work with investments from Middle East and the UAE, Saudi, and Kuwait, looking to invest in real estate and other asset classes in the US and Europe. And we have a number of structures that we've employed both for sort of straightforward conventional investments, but also Sharia compliant investments for certain pension funds and other state bodies in the Middle East.
Thank you. Craig Morris.
Good morning. My name is Craig Morris. I'm one of the partners with Chad at Pentaveret. I started in the real estate business in 1982 as an industrial broker with Grubb & Ellis. And in 1990, we created what was the first corporate services group in the US for managing corporate portfolios. And I ran that globally for many years, and along with the partnership we had with Knight Frank on the international side. And in 2004, I went over to Cushman & Wakefield and ran all the global outsourcing work for them, which encompassed 600-700 million square feet under management, 7,000 people, a couple hundred of accounts. And then right before the recession, I decided to get off an airplane and see my family, and we started a number of smaller service and sponsorship type businesses, and that's where I met Chad, and we created Pentaveret. So I appreciate being included.
Thank you, Craig. Maggie.
Hi, good morning, everyone. I'm Maggie Coleman. I am a Senior Managing Director and Head of International Capital for the Americas for JLL Capital Markets. I spend my time working with investors across Asia-Pac, Europe, and the Middle East who are articulating their capital strategy for U.S. investments. We work on opportunities from direct investment through JVs, recaps, and other vehicles. And certainly have been active over the past year in spite of some of the dislocation relative to COVID. I've been with JLL for 16 years. Prior to that was in investment banking, and very much looking forward to the dialogue today.
Thank you. So global capital conversation. Global capital investment dollars are still seeking commercial real estate investment opportunities worldwide despite a severe drop and slowing in transactions. Some investors are looking for more opportunistic acquisitions, hard-hit sectors, but they're also looking to stabilize cash preservation. Maggie, can you share with us what you're hearing from these investors with regards to their investment strategies?
Sure. It's been really interesting to see how investors have responded over the past, call it 9 to 12 months. We really started having active dialogue with investors outside of some of the traditional sectors of office, call it 24, 36 months ago, when Asian investors were increasingly looking at multifamily and industrial. I would say in what we've all experienced relative to COVID and the pandemic has really actually strengthened that desire to be in those sectors that have delivered consistent returns in the US over the past decade. And that, those defensive sectors are multifamily and industrial. And so we see an increased appetite from our foreign investors that we're working with to access those sectors in the US, which quite frankly, have traditionally been somewhat fragmented and smaller and include smaller scale assets than office. So it's taken some investors some time to really understand how to access those markets. We've seen investors looking for industrial and multifamily in scale. We've seen them seeking opportunities for generational holds in certain gateway markets. So the types of deals they're looking for range across the board, but it really is focused on those two sectors. I think, secondly, behind those, I would say, is data center and life sciences. And again, I think both of those sectors have been beneficiary of some of the tailwinds around, the rise in e-commerce and the rise in biomedical companies for based on what we're all going through relative to this pandemic.
Thank you, Maggie. Do you see different groups around the globe looking for specific things? Is the Pan-Pacific group looking for specific things? Are you seeing money from Europe or EMEA looking at different products, or very similar?
It really just depends around the type of investor. I think the larger institutions, whether it's the pension funds or the Singaporean REITs, they're all looking to build scale and to really create a foothold in the U.S. and with a strategy around top tier markets and scale across, whether it's the Smile States or again in diversified markets, innovation markets. That strategy is very different than, say, some of our investors who are either on the private side or family office, who are really looking for partners and will partner with owner operators here in the U.S. to help them that effectuate a transaction here. I think the one area where we have seen a tremendous appetite across the board has been single tenant, long let assets with e-commerce credit. And that's been the case for office, for industrial, and anything really touching, whether it's Amazon, FedEx, 3PL. Those assets we have seen be heavily bid across the board, from institution to family office, from Europe to Asia Pac. It is by far the most coveted type of transaction that we are seeing right now when we talk about direct asset acquisitions for foreign investors.
Thank you. Barry, you work in the real estate sector, but also others. Are you seeing similar movement of global money?
Yeah, I mean, I would kind of echo everything that Maggie said, and possibly amplify it as well. I mean, I think certainly I have a big focus on the Middle East, and a lot of my practice is out there. And what we are seeing is a notable spike, I would say, over the last 12 to 18 months. So this is pre-COVID, but COVID has only kind of accelerated that, in capital that's flowing out from the Middle East into conventional US private equity funds. And that is both conventional and Sharia compliant money. And one of the things that we've been able to do is develop a structure that really doesn't require any differentiation between the two. We can put a sort of an intermediary structure in place that allows a Sharia compliant investor to invest in either a single asset and take on conventional leverage at the asset level, or to invest into for instance, private equity fund, conventional private equity fund. There are certain restrictions, but we are seeing, and we have seen over the last 6 months, even during lockdown, new investment and new money being put into new investment opportunities in the US through private equity funds. So there has been a noticeable increase in that. And that is the same in Europe as well. But given that we're focusing on the US and the asset classes that people are interested in, and if you're looking at capital from the Middle East, real estate really is the primary asset class, because it's something that people really do understand. It's something they can feel and touch. Where people are perhaps less focused at the moment from a Middle East perspective is things like data centers, just simply because it's a little bit less typical. They're much more focused on sort of multifamily or family use developments. Logistics assets are becoming very popular, as Maggie was noting as well. That's a particular class of industrials that's particularly popular with people, given the rise in online retail, which seems set only to increase. So yeah, I think the general trends are capital flowing into the US because it's seen as the gold standard in terms of investment opportunities. You have the best investment managers in the US. And as trouble starts, and the Middle East is sort of hit with a double whammy at the moment between COVID and the oil price depression, which is seeing a lot of capital flow out from there to find a home in the US.
And so, Barry, you mentioned Middle Eastern money, new money coming in. How has the oil price fluctuation affected that? Have you seen it coming back, or is it still delayed, or they paused?
No, we're seeing a lot of capital being deployed. And I think one of the things that you find in the Middle East is, and this is particularly true, and so I don't want to sound like a broken record, but it's particularly true of Sharia compliant investors. They are sitting on a huge amount of cash. And of course, the issue with putting cash in a bank account is basically useless at the moment, given where interest rates are, or profit rates if you're a compliant investor. And so they really need to deploy that capital. Now, one of the issues they have is if you want to put your money into Sharia compliant products, the only things you have are sukuk, which are Islamic bonds, or fully Sharia compliant investment funds. Those are the two traditional asset classes. Well, sukuk are there's been a real dry up in issuance, and they tend to get snapped up by the other Islamic banks themselves. So if you're a large family office that's sitting on a big cash pile, your only other option is a fully Sharia compliant fund, but they are traditionally very low returns. So what investors are looking to do is put their money into real estate projects in the US that they see as being cash generative, and particularly ones that are being let out to logistics providers or the likes of Amazon, etc. Or they want to put their money into conventional funds in the US because the returns, frankly, are just much more attractive.
Right.
And if you can find a way, which we have, to bridge Sharia and conventional gap, which it is possible to do, then you have a win-win situation, both for fund managers in the US who are able to raise that extra capital and investors in the Middle East. But there's definitely not been that cash is sort of sitting there as dry powder, and that's just simply undeployed at the moment.
Thank you. So, global capital directed at the US. We saw an approximate 70% drop in investment in Q2 because of due to COVID-19. But there was still investment. People were still looking cross-border, coming in. A lot of the lists, the top 10 players. Canada is actually leading the way, as they have been for years, for cross-border into the US. Other top countries, Germany, Singapore, South Korea, Switzerland, Denmark, Kuwait, Japan, all rounding those out. Maggie, this money coming in, where are you seeing it actually being placed? Is it new assets? Are they refinancing? Where is this money going?
Well, I hate to sound like a broken record, but I think the bulk of this money is going into, industrial and multi, as well as, as I said, the appetite right now for single tenant long let deals has been tremendous. So what is notable about the various capital sources that you've mentioned in terms of, there has been a decline obviously across the globe in terms of transaction volume. But what's been really interesting is there's been some really positive storylines when you kind of dig into the numbers. I think one of the more active sources of capital that we've seen consistently in the US, and a source that's moved back into equity, is South Korean capital. What's been driving that capital source has been the low interest rates, which has for 2020 driven down hedging costs. And so we've seen South Korean capital, we were expecting pre-COVID a shift from their focus on debt and mezz back to equity. And we felt that as we moved through the COVID experience. What was really interesting is when you look at Asia-Pac transaction volume in Q2, it was down across the region with the exception of Korean capital. Transaction volume was actually up. And so I think that's indicative of the amount of capital that's that's been sitting on the sidelines for equity and continues to want to be placed into equity in the US. The types of assets that they are looking at, it's very much along those lines that we talked about, but very much, the Korean asset managers are looking for, call it, assets of 50 to 100 million. The pension funds will certainly want to place more capital, call it 200 million and above. And the formula for the asset manager companies and security companies is, a 5-year hold, 6.5 cash on cash return. And so again, those single tenant deals that I mentioned, as we're starting to see the cap rates on those compress, we're seeing Korean capital move into build-to-core opportunities with developers on those strategies, as well as new markets where they might get a bit more yield. I think the second capital source that we've been really engaged with again, and a lot of it's been driven by hedging costs coming in, is the German open-ended funds, who really were struggling to kind of go back into office in 2018 because of the compression in cap rates. And, you know, hedging costs for many of the Germans was over 200 basis points. So Germans actually saw positive inflows into their real open-ended funds during COVID. And I think, again, speaks to the amount of appetite, as Barry was talking about, for private capital to get exposure to the sector. So we expect the Germans to continue to be active. And of course, the Canadians, you know, have consistently been the largest, you know, importer of capital for us. And, you know, they invest across the sector. What I think is interesting, they're going into some of the niches around multifamily, so single family rental, manufactured housing, looking for those opportunities to see what's on the other side of traditional value add multifamily, given some of the dynamics happening relative to the pandemic and what's going on with the kind of middle income housing market. Craig,
We're seeing a focus and discussion where money's looking at industrial logistics. You've recently, I know from a little birdie told me that you've recently been to Seattle and seen the effect of Amazon. With the demand, everything that we're seeing within COVID, the industrial sector, distribution centers, the increase for more. Can you walk us through the Amazon effect and how you see it within the market and the appetite for new product?
Well, it seems like Maggie said, and multifamily and the industrial sectors are exceedingly strong. Every investor would like to have a 1 million square foot Amazon building, leased out for 10 years. And, the building cost is probably 100 million and they probably drop 300 million into the building. So, they're not leaving. So they're very much in demand, very much driving projects, whether it's from, the port cities and the gateway cities, whether you're in Phoenix or Atlanta, Nashville, whatever the case is, they are there. And what's happening also now is, as you've heard, kind of the last mile, there's a big push for the smaller facilities for Amazon into some of the suburban areas, really for a closer distribution hub to, for their trucking and their distribution areas to the homes. That's becoming very prevalent and very real. And even Southern California, where I'm based, they've started to reach out to J.C. Penney's and locations and some of these big retailers that have gone out and take some of those locations simply because they're so well located and have great loading, et cetera, and great access to freeways. So it seems like that expansion is continuing. It seems everyone that you talk to wants to buy industrial, wants to buy an Amazon building. They're not the only ones that are buying these buildings or building these buildings. But they are very prevalent in driving a huge amount of projects. The other thing that's happening, at least out here in Southern California, with some projects I know, you're starting to see a little bit of a pushback from the communities on these size of buildings. So what used to be just, burn and go and put them up, and you generally will have 2 or 3 or 4 of these. Now the communities are trying to buffer them, trying to get some smaller product around them, trying to make sure that the communities don't have an Amazon building as their neighbor in their backyard. So you just have to be a little bit careful.
So the U.S. marketplace, a title quote from the recent report, Real Capital Analytics, U.S. is no longer the global leader for commercial real estate investment. The article questions, due to this drop in transaction volume from a regional and national perspective, that there may be a less confidence in the U.S. commercial real estate market currently within what we see. The last time the U.S. was not leading global activity was the financial crisis. Maggie, agree or disagree that we're either losing confidence in the U.S. as an investment? It's
an interesting question, and you have to appreciate where I sit. I spend the bulk of my time talking with investors who want to invest here in the US. So I would say I disagree. I think, we are seeing investors who are increasingly savvy about real estate, whether it's institution or family office and private capital, see the US as the, still a very transparent, market for capital preservation. I think we've seen a broadening of interest from foreign investors to look at not only equity, but debt. And, I think what the conversations we're having is how can investors think about what are the opportunities on the other side of this experience that we're all seeing with COVID and the pandemic and the economic consequences. And we've talked a lot about the focus on defensive, but we're having a lot of conversations with investors who are looking for access to debt and the potential opportunities for workouts for some, for loans that they think, where they think that there's going to be opportunity. And foreign investors haven't traditionally had a lot of exposure to that side of the market here. And so we've had, questions on how do I access that, how do we access loans that might need workouts or that dislocation? How do we find other investors who want to effectuate some sort of private credit strategy? So, debt is something that investors are looking at. And it's actually, I think, we're having a lot of conversations around, is there going to be a return to suburban office? Is there going to be a resurgence of opportunities for foreign investors to get back into New York or into some of the gateways where you may see some cap rate movement and they can again participate? And then I think what's really interesting is with some of the foreign family offices that we're having conversations with is, do we see opportunity for generational hold, land sites in gateways where they weren't going to be accessible before, but perhaps some of this dislocation, whether it's a hotel asset or a retail asset or an office asset, affords them an opportunity to get access to a site that they'll hold for a very long time. So I think it's the U.S. continues, again, across the board from institutional to private capital to be very, very much a focus.
Thank you. Barry, with the same idea, do you feel that this trend will continue, meaning low activity, or from your perspective and from your side, how do you see this going?
I think that any sort of low activity is more of a temporary lull than a permanent shift, to be completely honest with you. I think the US market remains the strongest and most robust. And I think it's the one that people naturally fly to. In times of trouble, everybody goes into the US dollar. Everybody looks to the US. I have to say, whilst obviously the statistics are correct, it's not my experience, certainly with my clients who have been deploying new capital into assets in the US in the last 6 months. So whilst I know that, on the whole, investment is down, I haven't actually seen that happen. I've seen clients raising cash and deploying capital on behalf of their investors. So that sort of contrast. And so I'm kind of on Maggie's side and slightly sort of disagreeing with the hypothesis. No, I think investment activity will pick up again. I think it's natural that it will. I think as we get back to work, I think the statistics came out today, the UK economy is up 6.6% in the month. Which is still below pre-crisis levels, but you are seeing this bounce back. Now everybody's describing all different sorts of shapes of recovery, V's and all sorts of things, but I do think we're going to see a snapback. I think there's been a definite shift in the way that we all behave that's not going to change. I think it would have happened over 10 years, but it's now happened in 6 months. But I do still think that those trends were still, anyone taking a long-term view was seeing those trends on the horizon anyway. And it just happens that everything's just come closer now and the time periods have shortened. You are seeing obviously businesses go out of business, but I think they were limping towards wind down anyway over a 5 to 10 year period, and that's just suddenly happened to them. So I think there's going to be an increase in investment activity. I think it's going to come bouncing back. It has to, and I think it will.
So Craig, with constriction, the comments of low activity, I'm always going with, I see an opportunity. There's obviously some friction, there's an opportunity. Where is it, and where do you see that opportunity? And how would an investor find a really good gain here, considering what's going on and what we've been talking about?
I would agree that there's been a kind of a short-term lag. I think it's coming back. I'm hoping and seeing a little bit that prices have softened a little bit, although yields are still pretty strong. We love to see down markets creates opportunities. It seems like we've seen a fair amount of reasonable pools of assets owned by families starting to take some money off the table. It seemed in the beginning of the COVID, for 3 or 4 months, the markets were, especially the financial markets, were kind of frozen, just sitting and waiting. There were a number of commitments that were out that I had heard from people I know in the industry that had been pulled at the time to kind of put them in a bad position. But those escrows are still in place, and those closings will still occur now that everything's stabilized. So it's I like the market. I think it does create opportunity. It creates room for innovation. The debt markets are supporting what's happening. Even for traditional loans or CMBS loans, IO periods are 7-10 years. They don't blink at it. I just believe that there's a real opportunity to come in and take advantage of the growth that's going to continue, and probably post-COVID, post-election, post-unrest, continue to get back on track and have that growth for some period of time.
So there's been some recent data come out, a CBRE study on inbound, outbound funds to the US. And part of them was that only 5 of the 52 largest markets had a positive look, obviously the COVID restrictions. But those were all secondary markets. So we're looking at Sacramento and Oakland with regards to San Francisco, the outlying boroughs with Manhattan and New York. Craig, why should investment dollars look at these outliers or secondary markets rather than the big cities, San Francisco, LA, Chicago, New York City? What's in it for them, and why would they take a really good look at a secondary market?
The short answer, I believe, is higher yields. Lower cap rates, higher cap rates, higher yields. It seems, the gateway cities have always been a huge draw. The center for business, finance, manufacturing, distribution. With the millennials, they're looking for a little bit different thing. They're looking for great paying jobs. They're looking for a lower cost of living, which pushes them outside of the gateway cities, and a higher quality of life. And we love secondary or the non-gateway cities. I think there was a question about which markets. The Pacific Northwest I like. Austin has been growing quickly, but in Texas there's really no barrier to entry. Nashville has been on fire. Charlotte, Raleigh. There's a lot of great cities that, for the most part, look and feel like a core city, that can deliver a lot more opportunities, a lot more upside, and I think better returns overall.
Maggie, do you feel innovation cities are going to play a strong influence in the next 3 to 5 years for investment?
I do. I think the appetite and the focus around cities that have this really interesting intersection of technology, highly educated workforce, university settings, clusters of whether it's life science and biomed, all of those features are creating these corridors where you have investors that are looking at cities in a new way. So, obviously, Craig mentioned the Pacific Northwest. We see a lot of interest in the Seattles and Portland. Austin's always up on the, it's always high on the radar. Raleigh, Durham, those areas are increasingly a focus for foreign investors. But I also think that there's, again, corridors and submarkets within some of the other secondary markets like Denver, Nashville, that have these features that are deemed pretty attractive for long-term, investors. And so I think that those are starting to resonate. Again, I think a lot of that was driven by the demographic trends that Craig was talking about, along with, the sense that you might get a bit more yield in these markets and still have a pretty secure, capital preservation strategy.
Right. Thank you. Barry, a legal question for you. cross-border investors, how does that happen? How do they go through this process? It's not like you can walk across or open up a bank account to acquire these properties. What are the investment structures that you could advise on regarding global investment into the US? How does that work?
I mean, the truth is that it's very much driven by tax and tax situations. Now, I'm not a tax lawyer, so I don't want to overstep my my expertise. But generally, you have to be very mindful of the tax structures. Typically, what we end up doing is using special purpose vehicles, usually through the Cayman Islands and possibly through Delaware, to create a structure that works for the clients. And that depends on whether they're investing in real estate itself or whether they're putting money into a fund. But quite a lot of investors, particularly from the Middle East, already have investment entities that sit outside the Middle East itself, be that Cayman or another one of the offshore jurisdictions, Luxembourg or similar. So that is typically the way it goes. And then a lot of it will also depend on the structure of the investment. Is this going to be something where they're purchasing equity in a business, or are they purchasing a physical piece of land, or are they buying units in an existing fund? Is the existing owner going to remain in place to continue to manage the property and effectively sell down a stake, but retain sort of control and day-to-day management? And then it also depends on whether or not they're going to take on any debt at the level of the asset or possibly at the property owning entity. And then the banks that are lending into that structure will have something to say about how that structure is put together, mostly because they want to ensure that they have effective security at every level of the structure. So both the asset itself and then shares in any of the SPVs that sit in between. So as a result, Cayman being a very well-trodden path and a very sort of straightforward legal system, which is based on English law, and you have the benefit of effectively your Supreme Court it's called the Privy Council, but it's basically the Supreme Court in the UK. So you have some certainty around, it's a lender. I wouldn't say lender friendly necessarily, but it certainly doesn't give the debtor excessive rights as you might see in other jurisdictions. So it's a rather convoluted way of saying it all depends on what you're doing and how you want to do it. So there's lots of different things that are put in place, but typically you will find that there will be a property owning entity established in Delaware or in the Cayman Islands. And then it all depends, of course, within the US, because you've got your individual states. You have to be mindful of how property ownership is regulated within an individual state.
So it's not for the ease of heart. We want to go find someone to help us with this one.
Which is why you need a lawyer, so that's my plug.
So we're getting close. The final question around for everyone. Let's start with Craig. Your prediction for global capital markets and real estate investment here in 2021, what do you see?
Who's going to be the president, Chad? Like I said before, I believe once we get through the end of this year, hopefully there's a vaccine, hopefully elections are calm, and it begins to stabilize again for the next couple of years. It seems like the debt markets are pretty stable, pretty normal. We've been pushed off and recommended by many in the capital side. You can go now, or you can wait 2 years and probably be in the same place, which is very interesting. The asset types that Maggie mentioned early on, the industrial and the multifamily, continue to be strong. I think there's other ancillary asset types like storage and data centers, et cetera, that will be strong. If you're in the office, hospitality, retail side, I think it's going to be an interesting ride, probably a rough one. And I'm not sure anybody really knows where that's going to be. I mean, we heard Google and Facebook were not coming back to the office until mid-year 2021. That creates a tremendous amount of pressure on all the ancillary services that take care of all those employees. But I think it's going to be pretty solid once we get through this next curve.
Barry, predictions?
I sort of echo a lot of what Craig has said. I mean, I think once there is a vaccine, I think you may see a sudden surge of people returning to the office. I think the working from home is a nice novelty, but I think that novelty will start to wear off. And I think, you know, people are very conscious now about mental health, and I think people are really missing the human interaction. It's all well and good to sit online, but I think people really need that. Now, is everyone going to start going back to the office 5 days a week? I'm not so sure that's going to happen, but I certainly think people will be spending their time in and out. But something has to give, and I think the vaccine is a key, because I mean, I'm sitting here in the City of London today, and it would normally be at, you know, coming in at sort of 8:30, 9 o'clock in the morning, absolutely packed, and it's empty. It's like a scene from a film, you know, sort of 28 days later, like a ghost town. And all those ancillary services are really suffering, and that can't carry on. And the furlough scheme can't carry on because it's just money just being borrowed to pay people. So we do need to, that all needs to change. But I think it will, and I think people will be surprised. I mean, things are never as bad as people think they'll be. They're never as good either, but I mean, I think that there's going to be quite a strong bounce back from in the economy as people get back to work. But I do think there is going to be a lot more diversity. I think people are going to look outside traditional. You know, New York was always seen as the best place to buy real estate. Well, actually, now people have had their eyes opened and looking at all sorts of other opportunities. I think credit is going to remain cheap for the foreseeable future. And I think that, as a result, is going to give people lots of opportunities. And there will, of course, be casualties along the way, unfortunately, and some big brands that we're all used to seeing are going to collapse. But I think other ones will emerge.
And
Maggie, bring it all home. Predictions.
I concur with Craig and Barry, and I think as someone, I am one of those who was working from home with 3 children under the age of 6 and e-learning, and with a spouse who works, it is, going to be nice to return to the office. And so I think that there is some of the, work from home is and flexibility is great, but I do think people want that human interaction. As someone who works cross-border, the way that we're communicating now in terms of, teleconferencing, I see that as being, an increasing way. I see that as increasing in terms of connecting with people when you're not traveling. I do think, though, there will be a return to travel because, again, I think that face-to-face interaction and that rapport that you build, still is very critical to building relationships. And then as I agree with Craig on the points relative to the sectors that everyone is going to be focused on relative to some of the tailwinds we're seeing in demographic shifts. I think there's going to be an increased focus on some of the niches like self-storage, data center, life science, all of those, single family rental, all of those I think will be, again, top of mind when you look outside of just the main product types.
Well, thank you, everyone. This has been a fantastic conversation. I really appreciate all your comments and insights and your willingness to participate. Want to wish everyone at the Paris Real Estate Week a great set of meetings and conference. And we look forward to seeing everyone when business opens up and the airplanes let us fly around. Looking forward to all of that. And so thank you very much, and à bientôt.
Thank you very much.
Thank you.